Your 30s can be the strangest decade in your financial life. You may earn more than you ever have before, get better jobs, receive bigger raises, and still feel like your bank account is going nowhere. Meanwhile, someone making roughly the same money can reach 40 with a completely different financial foundation. The difference usually isn't intelligence. It isn't finding the perfect stock, and it isn't having a six-figure salary. It's what happens during the years when your income starts accelerating at the same time your expenses, responsibilities, and lifestyle expectations accelerate with it. Because your 30s create a dangerous illusion. You look richer on paper while becoming more expensive to maintain. And if you don't build a financial system before your lifestyle catches up with your income, your raises can disappear without leaving anything behind. Let's break down why that happens. And more importantly, what you can actually do about it. Imagine two people, Alex and Jordan. Both are 32. Both earn $90,000. Both have about $20,000 saved. Alex gets a raise and immediately upgrades the apartment, finances a newer car, and starts spending more on travel and restaurants. Jordan gets the same raise but automatically directs part of it toward retirement, investments, and a cash reserve. Neither person feels dramatically different 6 months later. But 5 years later, the difference becomes visible. Alex has a higher lifestyle. Jordan has higher financial capacity. That's an important distinction. Your goal in your 30s isn't simply to earn more money. It's to increase the amount of your income that becomes an asset. Because income pays for today, assets can pay for tomorrow. And the first financial mistake many people make in their 30s is confusing a higher income with a higher net worth. A $20,000 raise sounds enormous, but if taxes take part of it and lifestyle absorbs the rest, your financial position may barely change. This is why every raise should have a job before it arrives. You don't need to save the entire increase. You could divide it. Maybe 50% improves your lifestyle, 30% goes toward investing, and 20% strengthens your cash reserves or pays down expensive debt. The exact percentages aren't sacred. The principle is, your lifestyle should not automatically receive 100% of every increase in income. That one rule can dramatically change the trajectory of your 30s. Now let's talk about something less exciting but far more important: financial friction. Every recurring financial decision creates friction. You have to remember the payment. You have to decide how much to invest. You have to transfer money. You have to decide whether you're increasing your retirement contribution. And every decision competes with work, family, stress, and everything else happening in your life. That's why automation is so powerful. The best financial system isn't the one that requires you to make perfect decisions every month. It's the one that makes the good decision happen automatically. Your paycheck arrives. Your retirement contribution happens. Your emergency savings transfer happens. Your investment contribution happens. Then you live on what's left. That order matters. Most people do the opposite. They spend first and invest whatever survives. The problem is that money is extremely good at finding something to do. A larger paycheck creates more opportunities to spend it. Automation turns saving from a monthly act of discipline into a background process. And there is another number you should understand: your savings rate. Suppose you earn $100,000 and invest $10,000. Your savings rate is 10%. If your income rises to $120,000 and you still invest only $10,000, your income improved but your financial behavior didn't. But if you raise your investment to $15,000, you're increasing both your income and your financial efficiency. That is the game in your 30s, not simply earning more, converting a growing income into ownership. And ownership can take several forms: retirement accounts, broad market investments, a business, a paid-off debt that eliminates future interest, cash reserves that prevent you from selling investments during an emergency. The goal is to build a balance sheet that becomes less dependent on your next paycheck. That brings us to debt. Not all debt deserves the same treatment. A credit card balance charging a very high interest rate is fundamentally different from a lower rate mortgage or certain student loans. Instead of following a slogan like, "Pay off all debt before investing," look at the interest rate, tax implications, risk, and your available alternatives. High-interest consumer debt can quietly destroy wealth because the interest works against you every month. Investments have the potential to compound. Expensive debt compounds in the opposite direction. But there's another mistake here: becoming so focused on eliminating debt that you completely ignore retirement savings, especially an employer match. If your employer offers a retirement contribution match, understand the rules and make sure you're taking full advantage of it when it fits your situation. Free employer contributions can be an unusually valuable part of your compensation. Your salary isn't the only number that matters. Total compensation matters. And your 30s are also when housing decisions become financially significant. Buying a home can be a great decision. It can also be an expensive one. The mistake is treating homeownership as automatically superior to renting. A house has property taxes, insurance, maintenance, interest, closing costs, and the opportunity cost of the money tied up in it. So don't ask, is renting throwing money away? Ask a better question. Given how long I expect to stay, what does owning actually cost me compared with renting? That's an analytical question. And analytical questions produce better financial decisions than social pressure. The same applies to cars. A car is one of the easiest ways to convert a temporary increase in income into a permanent monthly obligation. The payment may look manageable, but the real cost includes depreciation, insurance, maintenance, fuel, financing, and the investment growth you give up by directing money toward the vehicle. You don't need to drive an old car forever. You simply need to recognize that every upgrade competes with another financial goal. And this is where lifestyle inflation becomes dangerous. Lifestyle inflation doesn't usually happen in one dramatic decision. It happens in tiny upgrades: a slightly nicer apartment, a more expensive phone, more subscriptions, more frequent restaurants, a newer vehicle, a bigger vacation. None of these decisions individually destroys your finances. The problem is accumulation. Your fixed monthly expenses become so high that your future becomes dependent on continuously increasing your income. That's financial fragility. A strong financial position gives you choices. You can change jobs without panic. You can survive a temporary income interruption. You can handle an unexpected family expense. You can take a career opportunity that pays less but has better long-term potential. Money isn't only about becoming wealthy, it's about purchasing flexibility. And there is one financial metric that tells you a lot about that flexibility: your monthly essential expenses. Know the number, not your total spending from a random month. Your essential spending: housing, utilities, food, insurance, transportation, minimum debt payments, necessary health care, and other obligations. Once you know that number, your emergency fund becomes much more rational. Instead of copying somebody else's savings target, you can build a reserve based on your actual financial structure. And finally, don't underestimate your human capital. In your 30s, your ability to earn may be your largest financial asset. A $5,000 investment might produce a modest return, but a skill that allows you to earn $20,000 more every year can completely change your financial trajectory. That means investing in education, negotiation, communication, technology, management, sales, or specialized expertise can sometimes generate a higher return than obsessing over tiny investment fees. The best financial portfolio in your 30s isn't just your brokerage account. It's your ability to produce valuable income. But here's the key: don't turn every increase in earning power into a higher cost of living. Use part of that increased income to buy back your future. If you are in your 30s right now, you don't need a perfect portfolio. You don't need to predict the next market crash. You don't need to find the next great stock. You need a system. Capture valuable employer benefits. Control expensive debt. Build an appropriate emergency reserve. Invest consistently in diversified assets. Increase your savings when your income rises. Keep major lifestyle upgrades intentional. And keep developing the skills that increase your earning power. None of this sounds exciting. That's precisely why it works. Financial freedom is rarely created by one spectacular decision. It's usually created by thousands of ordinary decisions that quietly point in the same direction. Your 30s won't determine everything about your financial future, but they can determine how difficult your 40s and 50s have to be. So don't ask yourself, how can I get rich quickly? Ask something more useful. How much of the money I'm earning today will still be working for me 10 years from now? That's the question that changes the game. If this video gave you a different way to think about your money, hit the like button, subscribe for more practical and analytical finance content, and comment below. What is the one financial decision you're changing this year? Thanks for watching, and I'll see you in the next one.